Good morning, everybody. Let's wait for a couple of minutes. So, good morning, everyone, and thank you very much for joining us today. On behalf of Baker Tilly Spain, welcome to our webinar. If you have any question, please use the Q&A chat, and we will try to address all of them at the end of the session. We are María Ángeles Mariñas, Manuel Peñín, Adrià Lizondo from the International Tax Office in Madrid. We usually advise individuals relocating to Spain, and we often work with US colleagues supporting private clients. But of course, our international tax team also helps US companies with tax advice or even tax compliance services. So let us know whenever you need assistance. Let us start with a very common situation. A US client says, I'm moving to Spain, or I want to work from there, or even I would love to buy a property in the sunny Spain. Here is where the issues begin. Will Spain treat him as a Spanish tax resident? Will Spain tax all his US income? What happens if he sells the current house in the US? Our objective today is very practical. We want you to leave this session with a clear framework, so when Spain appears in a client conversation, you immediately recognize the key points and the main risks. So everything starts with tax residency, because when a Spanish tax resident is triggered, the whole tax framework changes. Let's start with a brief explanation about Spanish tax residency rules. But one clarification first. Spain does not allow a split year residency. If a Spanish residency is triggered, it applies for the full calendar year. For example, imagine a US director moving to Spain in October 2026. From a Spanish tax perspective, if any of the tax resident criteria are met, Spain will consider him as a Spanish tax resident for the full calendar year, that is, from January 2026. So under our domestic law, there are two different criteria to recognize a Spanish tax resident, and they are fully alternative. It means it is enough to meet only one of them, not the two. The first one is based on physical presence, more than 183 days during the calendar year. Any day of physical presence in Spain counts, even partial days. If someone arrives at Spain very late in the night, that day counts. And if someone leaves Spain very early in the morning, that day also counts. But what about vacations or short trips abroad? Spanish law considers that sporadic absences are also counted as days spent in Spain, unless that you can obtain a tax resident certificate issued from another country. Therefore, what matters is not only physical presence in Spain, but whether there is an intention to return. So if someone leaves Spain for a few days, but clearly maintains the center of interest in Spain, and of course he intends to return, those absent days will be treated or considered as days in Spain. And now, the second test or the second criteria is based on economic interest. Spanish law refers to income and wealth without giving priority to one over the other. So it is not necessary to exceed 183 days in Spain because if the main economic interests are located here in Spain, the client may also be considered a Spanish tax resident. When during 1 year there is income generated in both Spain and the US, then the analysis becomes comparative. Where has the majority of income been generated? Or where are the main assets located? And finally, I know, I told you that there are only two tax resident criteria, there is also a third element to be considered. But this is a legal presumption. If the spouse and minor children are considered Spanish tax resident because of the application of any of the two above mentioned criteria, then the individual is presumed to be also a Spanish tax resident. But this presumption is easy to be broken if there is a tax resident certificate provided by another country. And what happens if both Spain and the US consider the individual as resident at the same time? Then, of course, we need to move for the application of the tie-break rules under the double taxation treaty. We all know the steps: permanent home, center of vital interest, habitual abode, and nationality. But what matters here is to know how the Spanish tax authority apply those concepts. For example, the first one, the permanent home, does not only refer to ownership. A rental agreement may also qualify. What matters is availability. If a property is at the individual's disposal, even if owned by a close family member, it may be considered his permanent home. Okay? And what about the center of vital interest? How is this interpreted by Spanish tax authority? You need to consider or understand that Spain does not prioritize personal interests over economic interests or vice versa. It's a practical analysis. For example, they used to consider where does the spouse live? Where do the minor children attend the school? Or where is the main professional activity performed? Or where are the key economic decisions taken? So it is not enough to have income only in one country to avoid tax resident in Spain. Tax authorities will also look at where the family life is really organized in practice. And finally, moving to the habitual abode criteria under the double taxation treaty. This is not just another 183 days rule. It is focused on regularity and pattern of presence in Spain. For instance, in very well-known cases here in Spain, the tax authority has studied travel records, credit card activity, gym membership, health insurance, and even restaurant or hairdresser appointment to reconstruct where someone was really living. So as you see, this is a very factual reconstruction exercise. So when the Spanish resident is confirmed in Spain, the next question for your client is not minor, but where exactly in Spain? Because actually, Spain is highly decentralized, and this has real impact also in taxation. For instance, wealth tax, inheritance tax, and gift tax are fully devolved to the autonomous communities. Don't worry about those taxes I'm mentioning because those will be further explained by my colleagues. But that's not all. Even in the personal income tax, the tax rate scale is composed of two different parts, a national scale and a regional scale. They are added together. That is why effective taxation will highly depend on the Spanish region where the client is living. So for instance, Madrid or Barcelona can produce very different results from a tax perspective. And so if it is so important, how is this regional residence concluded? again, mainly based on the days spent in each region or where the main economic interests are located, or finally, the last declared resident before tax authority. But of course, census registration alone is not sufficient to conclude or to prove the tax resident in one region. So now you know that if one client says, I'm moving to Spain, that's not enough. Your next question to address should be, but to which Spanish region? Because Spain is not a single union or unit from a tax perspective. And now that we know that you are working with a Spanish tax resident, it is very important to explain him that he will be taxed on his worldwide income. That includes, of course, US source income, US salary, US dividends, US capital gains, rental income from US property, or retirement distribution. Everything enters the Spanish tax base once resident is triggered here. But Spain separates income into different baskets: general income and savings income. General income includes employment income, business income, and most pension type income. And all of them are taxed under a progressive scale that can reach 45-50%, again, depending on the Spanish region where the client is living. Rental income also falls into this general income basket. But of course, several expenses are deductible. Then the net income after expenses is taxed under these general progressive rates. And something important and very particular here in Spain, even if a property is not rented, so it is not generating any real income, Spain may allocate some income only because the property is at the client's disposal. This presumed income is calculated based on the cadastral value of the property. On when the property is abroad and there is no this kind of reference, is calculated based on the acquisition value. But of course, this presumption or this special taxation only applies to second or third properties. Of course, it does not apply to the main usual resident. And moving to the second basket, savings income, including dividends, interest, and capital gains. And all of them are taxed under a different but lower progressive tax scale. Before we were talking about rates even until 45 or 50%. Here, for savings income, we are talking about a scale ranging between 19 and 30%. And what capital gains include? Well, it includes the sale of shares, obviously, but also the sale of real estate. So, if a U.S. individual becomes a Spanish tax resident and later he sells a house in the U.S., the capital gains will be taxed in Spain under the saving scale. Because remember the worldwide taxation for a Spanish tax resident. So, timing here becomes critical because selling before or after becoming a Spanish tax resident will mean a very different result. And finally, regarding the personal income taxation, of course, Spain allows a double taxation relief, but it's limited to the lower amount between the foreign tax really paid in the US or the Spanish effective tax applicable to the income obtained abroad. However, please notice that taxes paid in the US purely because of US citizenship may not deductible in Spain. And finally, from my side, because I also want my colleagues to speak, let us consider a very common real-life situation. An individual becomes a Spanish tax resident, but he continues to perform part of their duties abroad, not physically here in Spain. Is all the employment income taxable in Spain under this scenario? In principle, you know the answer is yes, since I have already told you that Spanish tax residents are taxed on worldwide income. However, I have good news for you. Spanish law also recognizes or provides a tax exemption for employment income corresponding to work physically performed outside Spain, provided, of course, that certain conditions are met. First, very briefly, the work must be carried out outside of Spain. Remote work from Spain, even if it is for a third country and paid from a third country, does not qualify for this exemption. And it is also important that the country where the duties or work is physically performed must have a tax comparable or similar to the Spanish personal income tax, and of course, not to be a tax haven. Second requirement for the application of this tax exemption. The services abroad must be for the benefit of a non-Spanish entity. If the services are provided to a related party, the exemption can still be applied, but if it is harder. The foreign entity must really prove that the benefit that those work benefit the abroad entity, okay? The foreign entity must prove the real benefit obtained from that work. However, when a Spanish entity is the ultimate or real beneficiary of those services performed abroad, then the exemption will never be accepted. I also have to tell you that Spanish tax authorities for the application of this exemption are very strict when we are working about certain types of activities. Internal meetings, general management activities, training session or conference abroad, those are normally not approved by Spanish tax offices. And finally, about this exemption. Unfortunately, there is also a quantitative limit. The exemption only applies up to 60,100 euros per year. Any excess will be still taxable in Spain. So as you see, this becomes a documentation exercise to prove work days abroad and who really benefits from the services. So it's finally time to introduce you to my colleague, Manuel. Manuel, I leave it in your hands.
Yeah, hello. Hello, everyone. Good afternoon, good morning for our US colleagues. In this part of the webinar, we will continue explaining the tax framework applicable to individuals coming to Spain from the US, as Marian said, and the various special regimes available to them for more efficient taxation. First of all, we will talk about wealth tax and the solidarity tax. As an introduction, individuals who are tax residents in Spain are subject to wealth tax on all their assets and rights, regardless of where these are located. This tax is payable on the total net value of taxable assets at the end of each year. The tax rates are also progressive, as in the case of personal income tax, and go from 0.2% to 3.5%. But they vary depending on the autonomous region. This is because the autonomous regions can vary the rates and personal allowances. A few years ago, some regions like Madrid or Andalusia created a 100% tax relief. So as you can imagine, there were important differences between regions for the purposes of this tax. However, this changed in 2022 when a solidarity tax on large fortunes came into force, which applies to net assets over 3.7 million euros. And was introduced by the central government to eliminate regional differences between regions in the wealth taxation. And what does this mean for taxpayers? So, well, in practice, wealth tax is now applicable in the entire Spanish territory. which means that the nil rate band in regions like Madrid or Andalusia is effectively 3.7 million euros nowadays, whereas the nil rate bands in other regions is different. For example, in Catalonia is massively lower at just 500,000 euros. On the positive side, to prevent excessive taxation, there's a combined limit. Your total personal income tax liability and wealth tax liability, their sum, cannot exceed 60% of your taxable income for the year. And there are also several exemptions, like the value of the main residence, which is exempt up to 300,000 euros per year, or the value of the shareholding in companies that carry out an economic activity. So as you can see, these are important factors when advising on global mobility issues for US clients. Let me now turn to the Spanish Inheritance and Gift Tax, the IGT. Yeah, this tax applies whenever an individual experiences an increase in net worth as a result of receiving assets without providing consideration in return. In practical terms, it captures first wealth transfers that occur upon death, when a person acquires assets or rights as an heir or a legatee. Second, IGT also applies to lifetime transfers made without compensation, gifts of property, cash transfer, or the assignment of rights free of charge fall within the scope of this tax. It's important to note that the legal form of the transaction is that there's a cost-free transfer resulting in an enrichment of the recipient. And finally, beneficiaries of life insurance policies may also trigger taxation where the policy holder and the beneficiary are different individuals. For all these transactions, where you live matters enormously, as the tax liability depends on the recipient's residence status. Why? Because individuals considered tax residents in Spain are subject to IGT on assets received anywhere in the world, but non-residents are only taxed on property and rights situated within Spanish territory. So determining the location of assets, particularly financial investments or real estate, become a critical step in cross-border situations. In addition, an important distinctive feature of this tax is its high degree of decentralization. Although IGT is regulated at the national level, substantial legislative powers have been transferred to the autonomous region. And these regional governments can administer, assess, and collect the tax. So they may introduce their own reductions, allowances, and tax credits within the framework permitted by the national law. And as a result, the effective tax burden can differ dramatically depending on the applicable regional legislation. For example, two beneficiaries receiving identical assets may face significantly different tax outcomes depending on which region has the right to impose the tax. And finally, it's important to know that the calculation doesn't rely solely on the value of the assets transferred. It also varies on individual circumstances of the beneficiary, such as their relationship to the deceased or donor, their age, any recognized disability, or their pre-existing wealth. Regions apply reductions or adjustment coefficients based on these factors, which can substantially reduce or in some cases increase the final liability. For example, regions such as Madrid currently grant a 99 tax relief on inheritances and gifts between parents and children or between spouses. In contrast, in Catalonia, these benefits apply only to certain types of assets or are subject to capped exemption limits. For this reason, I believe that a careful analysis is essential when planning wealth transfers in Spain, particularly in scenarios involving multiple regions or international elements. Let me now walk you through the Spanish tax implication of common US holding and investment structures when individuals or companies operate in Spain. First of all, it's common to see members of S corporations and LLCs, which are treated as disregarded entities for US tax purposes, as they are not subject to US corporate income tax, so revenue passes directly through to its shareholders. So both types of companies are tax transparent for US tax purposes. In this regard, as a general rule, Spain usually respects that tax transparency, provided, of course, the entity is treated as such under US law. Under Spanish tax principles, this leads to the application of what we refer to as the income attribution regime, which in practice means that the Spanish resident shareholders are taxed directly on their proportional share of the profits. So two technical consequences follow. The taxation occurs at the level of the shareholder, not the entity, and the income preserves its original character. For example, if the US disregarded entity generates business income, capital gains, dividends, or rental income, that characterization flows through and is maintained for Spanish tax purposes at the level of the shareholder. This can often create complexity, particularly when determining how income is classified under Spanish domestic rules and the applicable tax treaty provisions. The second type regarding C corporations and LLCs that choose to be treated as regarded entities for US tax purposes, these companies are subject to US corporate income tax and have a different tax treatment in Spain should a shareholder become tax resident. Well, according to the tax treaties between Spain and the US, income obtained by a US regarded entity will be subject, of course, to US corporate income tax, but only part of this income can be taxed in Spain. Is the part of the income that can be taxed in Spain is that attributable to a Spanish permanent establishment. In that case, where a permanent establishment is detected because of the presence of the shareholder, the taxation of the permanent establishment will be calculated at 25% on the net income, in accordance with the corporate income tax regulations. And this analysis of whether a US company operates in Spain through a PE must be carried out on a case-by-case basis, depending on the company's or depending on the final company's presence in Spain. And finally, the dividends paid from these US regarded entities to tax resident individuals in Spain are subject to personal income tax as savings income, as Marian said before, at the progressive tax rates from 19 to 30%. Now let's take a look at US trusts, because it's important to note that trusts are not recognized in the Spanish legal system. Spain is one of the European countries which has no law regulating trust or similar institutions. For the purposes of our legal system, the relations between the contributors of goods to trust and their beneficiaries are deemed to be made directly between them, what we call what we call trust tax transparency. And so the trust is considered not to exist. So as if the trust didn't exist. But having said that, depending on the particular arrangements of the trust, the transfer of assets in favor of the beneficiaries, subject to IGT in principle, may be either at the time of contributing assets to the trust or after the death of the settler. So, in order to determine the treatment and effects of trusting in the Spanish tax system, we should analyze the specific characteristic of each trust, the local legislation, and the clauses of the trust's founding deed. For this reason, I believe that at the end, trusts, there is no legal certainty around trust for the purposes of the Spanish tax law. And finally, let me address the Spanish tax treatment of U.S. retirement accounts, IRAs, once the individual becomes tax resident in Spain. Because under Spanish personal income tax rules, withdrawals from U.S. individual retirement accounts are taxable in Spain. And the classification of the income depends on the origin of the contributions. The Spanish General Directorate of Taxes has laid out the criteria to determine how these amounts must be reported. First, where the retirement plan was funded through employment-related contributions in the United States, meaning amounts derived from the employee's compensation package and where applicable, matching employer contributions, the distributions are treated in Spain as employment income. So as a result, the amounts received are integrated into the general tax base and are subject to progressive rate, which, depending on the autonomous region, may reach approximately 50%. In our practice, this has a significant practical impact because the entire amount withdrawn is typically taxed at ordinary scale rates, potentially pushing the taxpayer into the highest brackets in the year of distribution. However, when we are dealing with a Roth IRA funded exclusively with post-tax personal savings and not linked to an employment relationship, the Spanish tax authorities classify the distributions differently. In these cases, the amounts received are included in the savings tax base rather than the general base. Consequently, they are subject to savings tax rates, which currently ranges from 19 to 30%. This distinction between these two categories is critical from a planning perspective. It affects not only the applicable tax rate, but also cash flow projections, timing of withdrawals, and coordination with other income in the year of receipt. Therefore, I think that before becoming a Spanish tax resident or before triggering significant distributions, it's essential to analyze the nature of the contribution and the expected Spanish tax impact in order to avoid unexpected taxation or marginal taxation too high. Let's now turn to the special tax regimes, both of which are named after soccer players. The first one is the special regime for workers posted to Spanish territory, commonly known as Beckham Law, which is a special tax regime for individuals moving to Spain for work reasons. Under this regime, you are taxed as a non-resident for up to 6 years, the year you move, plus 5 more, but you must not have been a tax resident of Spain in the previous 5 years. And to be eligible, you must move to Spain for specific work reasons, such as employment in Spain, get employment in Spain, including remote work, becoming a director of a Spanish company, having a favorable report from the legal institution ENISA for specific innovative activities, or engaging in a high-level professional activity for certain startups or certain R&D activities. But it's important to know that you cannot use this regime if you earn income qualified as obtained through a permanent establishment in Spain, like self-employed income. So you can't carry out a professional activity nor have a relevant shareholding in the professional entity which pays your salary, which is a very important limit to consider in practice. And what does this regime imply for the taxpayer? Well, opting into this regime means that personal income tax liability is calculated only on income obtained within the Spanish territory, as per the rules established in the non-residence income tax law, but with certain special features. First of all, general income, which is employment income, rents, as Marian explained, is taxed at a flat rate of 24% for the first 600,000 euros. The excess over this amount is taxed at 47%. To give a general idea, if we talk about employment income, it's generally better to choose to be taxed under the special regime in Spain if the employment income received is higher than 60,000 euros per year. But it's very important to note that under this regime, all employment income is considered to have been obtained in a Spanish territory, meaning that worldwide employment income is taxable in Spain at the flat rate of 24%, of course, up to the first 600,000 euros. Secondly, savings income, dividends, interest, etc., from Spanish sources is taxed at progressive rates from 19 to 30%. So only dividends from Spanish entities will be taxable under this regime, and therefore, those dividends from foreign entities will not be taxed in Spain. Also, real estate income from real estate located abroad is not taxable in Spain under this regime, since only income from Spanish properties is taxable. And finally, wealth tax. As I said before, to Spanish tax residents, under the general regime, wealth tax applies to their worldwide assets, but for taxpayers covered by this special regime, wealth tax affects only their Spanish assets. So foreign assets are outside the scope of wealth tax, which is an important advantage. But, however, there is also potential disadvantages to consider, because by opting for this special tax regime, they will not be able to take advantage of the benefits of most double taxation treaties to restrict their taxation as non-resident in other countries. And nor do they have the right to deduct expenses for personal and family allowances in their personal income tax calculation. Another interesting tax relief, is a new tax relief in the Community of Madrid for new taxpayers coming from abroad, which is commonly known as the Mbappe Law. Effective from January 1st, 2024, it offers a 20% tax relief on investments in qualifying assets, like bonds, securities, or shares, as long as certain requirements are met, of course. The first one is that you become tax resident of Madrid. Second, you haven't been a Spanish resident in the past 5 years. Third, you maintain your residence in Madrid for 6 years. And finally, the investment is made in the year you become a tax resident or the following year and held for 6 years. If the investment is sold before the end of these 6 years, you can reinvest within 1 month to keep the deduction. And this tax relief applies to the regional portion of the personal income tax liability, which is about half of the total tax liability. The deduction is applied in the tax year in which the investment is made and in the following consecutive year in the event of insufficient tax liability. So what does this mean in practice? This means that a person who makes a significant investment during their first year of residence in Madrid can avoid paying half of the personal income tax liability for 6 years because of this tax relief. Okay, thank you. And now my colleague Adria is going to continue with the Form 720 and the taxation as non-residents.
Hi, everyone. Yeah, so as Manu already said now, we'll follow up with the Form 720. And this is one of the obligations, one of the obligated forms to be submitted when you're considered tax resident in Spain before the end of March of each year. Any person who is resident in Spain, fiscal resident in Spain, and hold assets abroad must comply with the 720 form. This obligation applies to individuals, companies, and legal entities. And it is important to clarify that Form 720 is purely an informative requirement. It does not involve the payment of any tax. It's only a reporting obligation. In this form, only the assets located abroad must be declared, and for this purpose, there are three categories of assets that must be reviewed. First of all, foreign bank accounts, so all foreign bank accounts must be declared. Shares and other financial investments, such as investment funds, for example, must also be declared in this form. And lastly, real estate properties located abroad, so not the ones in Spain, but the ones abroad. If any of these three categories exceed 50,000 euros, the taxpayer must fill the informative declaration. If any of these categories individually exceeds this threshold, it's not compulsory to present it. And lastly, if the Form 720 has already been filled in the previous years, it will only be compulsory to fill again to update if the value of any of the three independent categories have increased by more than 20,000 euros, or if the ownership or the condition that made it compulsory to declare has been lost. This basically means that if the asset has been sold or it's no longer on your property, it would be compulsory to declare again. And this is basically the framework applicable to Spanish tax residents in relation to all the foreign assets. We'll now continue with taxation as a non-resident in Spanish territory. So the key taxes applicable for non-residents, which would be US residents that have some type of asset or any tax obligation in Spain, would be the non-resident income tax, the wealth tax, and inheritance gift tax. My colleagues have already explained a bit how this works for residents. For non-residents, it's a similar treatment, but with some differences. Regarding the first of all, the non-resident income tax, it is necessary to review the double taxation agreement and the domestic exemptions to determine whether the income is subject to taxation in Spain. The applicable rates would be 19% for EU residents and 24% for any other country. So your US clients would be taxed at a 24% rate. In addition, there is imputed income for non-leased property, which Marian talked about, and we will cover now shortly more in detail. Regarding wealth tax and inheritance and gift tax, there is a real obligation only for assets and rights located in Spain. So not being considered a fiscal Spanish resident, you will only be obligated to pay wealth and inheritance and gift tax on assets located in Spain. As Manuel also explained, tax for these two tax rates and exemptions and deductions are determined according to the autonomous community with the highest value of the assets. Therefore, taxation may change a lot depending on where the highest value of assets are distributed in the Spanish territory. Yes. And then now talking about real estate income, according to the OECD model convention, income derived from real estate may be taxed in the state where the property is located. Therefore, Spanish real estate income is taxable in Spain. There are basically two types of income produced by the real estate. Firstly, income from renting Spanish real estate is taxed under the non-resident income tax. The rates are 19% for residents of the EU and EEA, applied to the net income. So expenses related to the property can be deducted from the gross income and will only be taxed on this net income. When calculating this net income, the same rules that apply for Spanish tax residents in the personal income tax are also applied to non-residents. So there's no differentiation between EU residents and Spanish residents when it comes to the deduction of expenses. However, for other residents, such as US residents, the tax rate is 24% applied to the gross income. So no related expense can be deducted from the income received. Just as an example, if a US resident has a flat rented in Spain and rent is 25,000 a year, it would be taxed on those 25,000 without a deduction of any expense. Deductible expenses would be, for example, property tax, rental management, or the depreciation, among other expenses that can be deductible. And so none of these expenses would be deductible and it would be taxed at a rate of 24% on the gross income. However, there has been a ruling from the from the National Court stating that non-resident taxpayers are entitled to deducting the expenses directly related to the rental activities when determining the taxable income from rented properties in Spain under this non-resident income tax. This interpretation is a significant development, particularly for taxpayers from the US, which, by a strict reading of the rule, would always be taxed on gross income. However, it's important to clarify that this new ruling from the National Court is not binding in general terms, and it does not automatically modify the legislation, nor does it formally change the tax rules applicable. Therefore, although it provides a strong interpretative argument, its practical application must yet be confirmed by the Supreme Court so that the interpretation is binding to the tax authorities. This ruling is, as I mentioned, especially relevant for US residents as it is a substantial change on the taxation of rental income. Moreover, this case has been promoted by US residents in front of the National Court and not the Supreme Court, and for that matter, is especially applicable to US residents, which, well, as I have explained, being taxed on the gross income or in the net income would be a huge change when calculating the tax that would arise from rental income. The other type of income, Marianne has explained it a bit, it's the imputed income. This income is applied to properties in Spain when the property is available for the owner's use, and this input income is generated is like a notional income, and this income is taxed. This income is also taxed under the non-resident income tax, and imputed income is based on the number of days, is calculated based on the number of days the property is available for the owner. So say the property is rented for half of the year, then imputed income would be paid on the remaining half when the property was available for the owner. However, if the property, although not being rented, is actively offered to rent, this imputation may be avoided, which is also important to take into account. As for the calculus, the taxable base is 1.1% of the cadastral value, or 2% if this cadastral value has been revised. Um, the catastrophe value is an administrative value that each property is given by the Spanish land registration for tax purposes. It's not the market value. It's usually significantly lower, although in some cases it may be higher. And it's yeah, normally it's not the market price, but a bit lower. And this value is determined by tax authorities based on objective criteria such as the location, size, use, condition, and land value overall. Yeah, and again, the tax rates would be 19% for EU residents and 24% for other residents or US residents. And that's all from our side. Thank you very much. I think if we got any questions, then we'll be answering them.
Thank you, Adria. I see we have no questions at the moment, so feel free to send any doubts that you may have at the moment. But if you don't, we can close our webinar, and of course, you can find our contact details at the end of the presentation. As I already mentioned, we are based in our Madrid offices in Spain. And thank you very much again for joining us. And I believe we will share the presentation later today or tomorrow. And nothing else from my side. So have a lovely day and bye.
Bye bye. Thank you very much.